Any of you guys ever shop at Five Below? I've actually been in there a few times. I think it's kind of cool. Not that that means stock's going up, down, or sideways, but I just think it's kind of cool. Okay, stock is 124 basically. What is the expected move here? Yep. Good, Robert. Love that. It's right about 10 bucks. Okay, expected move of 10 bucks gives us a range of 114 up to 134. Let me bring in a chart here. Okay, so the 200-day moving average, which is down below here, has been incredible support. That's the blue line. Just above the 50-day, which is the red line, you can see there's a significant amount of resistance. Here, it obviously did break through up here, but then it hit that same point again. Okay, it has been making some higher highs and higher lows, if you look at the chart there. Okay. Again, there's going to be a big crapshoot here about guidance and tariffs, just like, you know, every other stock that's out there that is beholden upon goods, products coming from China. I'm looking offline here at some metrics here. Looking to see if there's been any revisions. Okay, the market pricing is expecting to see margin drops, so that's kind of built in there. All right, so let's take a look here. Yeah, IV is very high. Okay, so 200-day moving average, which was basically 121, is support, and lots of resistance right around 134 to 135. Okay, let's look at an iron condor. So the 115, 113, and 133, 135. Probably going to be a little light. Okay, not horrendous. If we could truly get 90 cents for that, that is not bad. Harvey, I will look to that. That's a little light for me, reward to risk wise. But we'll look at that one. So this is the 115, 113, and 133, 135 iron condor for 90 cents. Puts our break evens at 114.10 up to 133.90, which is right at the expected move. Whoop, the expected range. Okay, and the reward to risk on this, a little bit lighter than we would like to see. But not horrendous. 0.82 to 1. Okay, this is all this week, Harvey. I'm looking at this week. June weeklies. Now, Harvey, you mentioned the 110, 115 iron condor. So $5 wide on the downside, $4 wide on the upside. But you must be looking at next week, or even the week beyond that, because this week that's only trading for $1.60, not $2. So I would never trade that for $1.60. What expiration were you looking at, Harvey? Harvey, what expiration were you looking at? Okay, Harvey, what expiration were you looking at? That couldn't have been this week, because this week is trading for about $1.60. So not sure what you were looking at there. Okay, the monthly, that makes more sense. Yeah, I certainly don't want to sell that going out 2+ weeks for far less than 1-to-1 reward to risk. I don't really like that much. Okay, let's take a look at a upside call calendar here. probably about 60 cents on that call calendar. And that's right about fair. I wouldn't say it's anything great. It's right about fair. I kind of like that iron condor that we first came up with here, guys. So going back, let me put this back up here. And I'm actually going to widen this out just a little bit. So here I've widened this one out $1 wider, so a $3 wide iron condor. This is the 115, 112, and 133, 136 iron condor for $1.30. Still lighter than the 1-to-1. Break evens here now become 113.70 up to 134.30. Reward to risk is 130 over 170, which ratio-wise is actually a little bit worse than the first iron condor. Let me price back out that first iron condor, guys. I kind of like that the best so far. And what I actually did here was I lowered the put side strike just one. This is the signal I'm going to put out here, guys. I am definitely putting out this iron condor signal. At 90 cents. Now, something to be aware of, and Pamela, this really goes to your question earlier of kind of why does it matter the conditions and where the stock is when we're looking at something. Stock is down $2 today, that's fine. But the expected move, the expected range that we have calculated is based off the stock being right here at 124, right? If the stock moves $1, $2, $3 today, that's going to give us a different expected range, which would give us potentially different strikes to trade. However, right now, this is where the stock is. So I'm going to put this iron condor out, but it's going to have a range of 123 to 125 on the stock. If the stock moves outside of that range, this signal will not be valid. Not saying that we wouldn't be able to get filled at 90 cents, okay, it's not that. It's because we would then have a different range and we would choose different strikes. Does that make sense? So Pamela, if the stock moves from here, right now it's trading 124. If the stock moves from here, we would potentially want to change strikes that we're using because the expected range then is going to change. So that's why this iron condor spread that I'm putting out there using these specific strikes will only be valid in a range of 123 to 125. No, Robert, we're good. If we can get filled at this price with the stock trading in that range, I'm willing to take it. But if the stock moves outside of that range, then no, we want to adjust the signal. Well, Harvey, you just have to kind of watch it closely then, unfortunately. Okay? Everybody understand that concept? And why we use the contingencies? Well, no, if it goes out of that range, if you use a range of 123 to 125, Pamela, even if the price of 90 cents is still there, if it goes outside of that range, your order is going to cancel. That's what the contingencies are made for. All right, let me get this out here, guys, and I'll be right back.